Welcome back. We're doing another group analysis, group stock screener, whatever you want to call it. These were all requested companies, and usually people have requested them. They come in at a pretty good discount, so I'm excited to go through them. I really haven't looked at these at all, so if you think I'm being ridiculous or stupid going through some of this stuff and missing some obvious things, I wanted to kind of keep it that way, where I'm kind of looking at it for the first time because I wanted to try to simulate what my screening process looks like, okay? Obviously, whenever I screen a stock, it's not this formal, but I think it's some of the same thought processes and things that you'll see. So let's get started. Let's just go through an overview of all the companies. Academy, they're the sports retailer. Big Lots, they're a housing retailer, furniture retailer. Huntington Ingalls is a military contract company. Let's see, engages in designing, building, overhauling, and repairing military ships. So specifically for the Navy, unless that means spaceships. I think it's the Navy though. All right, HP, that's the computer company, right? Personal computing and other access devices. Keurig, Dr. Pepper, two things I hate, all right, but they could be a good investment, right? Keurig is the little coffee thing that's one cup of coffee instead of, a whole pot of coffee. And then Dr. Pepper's just, a soft drink, worse than Coke. All right, lastly, Waste Management. Waste Management, what do? They manage waste. No, they're the trash service and stuff, so and environmental services, that type of thing. All right, so let's get started. We're going to go through all their balance sheets, all their income statements, and just get like kind of a green light, red light, yellow light measure on them, just kind of what I'm feeling. And then on the income statement, we're also going to derive a very rough estimate for value, and that's what we'll do. So let's get started with Academy. All right, so this is Academy. This is their balance sheet. And real quick, you can see what company we're on because it's up there, top right of the screen. All right, so one thing with Academy, and you'll see this right away, this is every quarterly result, but this is all I could get access to through Yahoo Finance. I think they might have a couple more quarters, but for the balance sheet, I only got back, the last 7 quarters, so less than 2 years of data. So it's going to be pretty hard to make a definitive, guess on this. It's not a guess, a definitive yes or no on this, but we're going to go at it. All right, so this is their equity. We like to see their equity growing, okay? I think that's a great judge of a company. You can look at earnings, you can look at cash flow, but if equity per share is not growing and they're not paying a big dividend, then something's up, no matter what else is going on in the company. But all right, I'm digressing. Let's go fast through here. All right, so this growth recently, it's modest. What went from, it's not that bad. $1 billion of equity to $1.4 billion of equity. But I always like to compare this to your debt loads. We're going to do a debt to equity ratio. So keep that number in mind, $1.4 billion of equity. I'm going to go to total liabilities and see that we're at, over 3. So what is this? 3.3. So 3.3 divided by 1.4. Our debt to equity ratio is 2.35. The textbook answer is like a debt to equity ratio under 2.5 is good. I prefer under 1.5 or 1, just as low as possible, but that's okay. It's not great. I'm not super happy with that. And then last thing I want to look at here is inventory, right? Because Academy is a retail company. They buy equipment and stuff and then they sell it in their stores to us. So inventory growing would be kind of concerning because it's not like they're buying a bunch or getting ready to sell more. If they're growing inventory, it means that stuff's building up in their stores, which means it's not leaving out the front door, right? So this is a little concerning. The inventory went up from $1.1 billion all the way to 1.3. So let's see, 1.3 divided by 1.1. That's an 18% increase on a quarter over quarter in inventory. So that's something that you'd want to watch in the next quarterly report to see if anything changes there. All right, so the balance sheet, I'm giving a yellow just because the debt to equity ratio isn't outstanding. The inventory's growing a little bit. That's it. One thing you're going to see with me is that I'm going to do a lot of yellows. It's very hard for me to give a green to somebody as far as a quality of the income statement and balance sheet goes. So I'm going to be picky there. It'll be easy for me to give a red if I don't like it, though. All right, let's go to the income statement. Total revenue. Look, revenue's growing. That's good. All right. What else? Gross margin. This is a great way to judge competitive advantage. Once again, the textbook answer here is like a retail company. If they're over, I think the number is like 42.5. Oh yeah, if they're 42.5, they're good. Not 41. No, that's ridiculous. You want to look at them compared to everybody else, and really you just want to make sure that their margins are stable. That's my opinion on margin. Different companies can run with certain margins, and that might be in their business model. What you want to look for is if a company is having to reduce its margin to keep up with market share and stuff, because that's the big concern. And you can see in this case, they're not really reducing margin at all. They're at 35%. I'm happy with that. There's nothing concerning here. So we got growing revenue and margin steady. That's good. I'm going to look at pre-tax income real fast. So how much money are they bringing in pre-tax? And yeah, I mean, this is great growth over the last year. I mean, this is kind of crazy. I mean, I understand that this is the COVID area where nobody could go out, but still, I mean, they've definitely seen an uptick. One thing I worry about with Academy is that this is temporary. I mean, if you remember, something like Peloton had the big spike, and now they're actually stopping production because everybody who was buying exercise equipment during COVID is like not buying it anymore. And Academy does a lot of exercise equipments and outdoor equipment, so I worry that that was maybe a little bit of a COVID fad, but that's me thinking big picture, not looking just at this, income statement. Just looking at this is awesome, to see this growth. If you, in a vacuum, if you said, okay, you're going to grow your pre-tax income on a quarterly basis from $50 million a quarter to $200 million in 2 years, I would say, well, that's outstanding. That's a green. So I'm going to give them a green for that because their revenue's growing, margin's stable, and their pre-tax income is growing. This, remember I said that the inventory had risen? This is kind of also a consequence of that, I bet. So inventory went up, remember, 18%, and then they dropped from 240 to 200. And if I do 200 divided by 240, you can see I get 0.83. So that's 17% drop in income, 18% rise in inventory. You can see how it kind of goes hand in hand. So I bet that's what's going on. Anyway, look, like I said, revenue's growing, pre-tax income's growing, and margin's steady. They are getting a green. All right, let's get an estimated value. All right, so I want to include everything that I got, and I'm just going to do a quick, my rule of thumb for pre-tax income. So the average income I get for a quarter for Academy is $111 million per quarter. So 111 million times 4, that's an estimate of $444 million for the year of pre-tax income. And then, like I said, my rule of thumb method, this is like the first thing I do if somebody gives me a stock to go look at. I just go look at what I think the pre-tax income's been or has been and multiply it by 10, and then look at that number compared to the share price. So multiply this by 10, I get 4440, and that's in millions. So I need to get to billion. So I divide by 1,000 to get back to billion. And you can see it's a $4.44 billion market cap compared to what they're currently selling at, which is a $3 billion market cap. So that's pretty good. That's going to be higher. So how do I get an estimated share price from that? You just ratio it down. So 4.44 divided by 3.0, because that's the current market cap. And then you multiply by the share price, and you get a share price target of $50. All right, right on. That's awesome. 2 greens, 1 yellow. I think that this one's got to be watched. I think that there's a lot of potential here. I'm worried a little bit about the cyclical nature, that we might be at a peak here and coming down fast because of some COVID stuff. And I'm worried a little bit about the inventory going up, but that's stuff for a different video, a deeper dive. But that one's definitely piqued my interest, right? All right, let's go to big lots. All right, first up with big lots, we're going to look at total assets. Okay, so this is interesting. So anytime you see a spike up in total assets, you got to think, okay, did they make an acquisition, or did they do something to dilute shareholders? Did they sell something and bring in a, well, if they sold something, it wouldn't be an uptick, right? Because if they sold something, they'd get more cash, but they wouldn't get more assets. So really, this is going to be like a dilution or a acquisition, and sometimes both at the same time. So let's see. If they made an acquisition, usually you'll see an uptick in goodwill, because whenever somebody buys something above book value, you'll see, okay, no goodwill, no increase in goodwill. And goodwill, even in this period, was low. Okay, so that's interesting. Remember, this data is from Yahoo Finance, so it's definitely subject to some discrepancies. It's not pulled directly from their financial statements. I mean, it is pulled from there, but sometimes there's errors where they actually could have goodwill and it just counted it as something else. So I just thought that was interesting. Let's look at their cash. See if that went up. Yeah. So cash went up big time and then came right back down. So that's kind of strange. That would mean, to me, that would tell me that they diluted shareholders. They raised equity by issuing new shares, got some cash, and they did something with that cash. So let's see. Let me look at number of shares real quick. Remember, this is big lots. All right, so number of shares. All right, this is like the opposite of what I thought I was going to see. What the heck? I mean, this is great, right? The shares are going down. Shoot, if you've been a shareholder since 2006, all right? From 2006 to now, you've had your shares, you've had your ownership stake increase by like 4 times. That's crazy. That is awesome. And then recently, they've really been buying back shares. So that's a good sign. I kind of like seeing that. I mean, of course I like seeing that, right? If a company's buying back shares, that usually means that management thinks the stock's undervalued, because it's not smart to buy back shares if the stock's overpriced, right? So by buying back shares, they're signifying that the stock's undervalued. So that's awesome. That's a great sign. Look at these share buybacks. All right, they're getting a green for that alone. All right, let's go to the income statement. All right, total revenue growing, but man, not as much as I would. I mean, I hesitate to call this growing. I mean, over this is what, going back to 2005, so you're talking 17 years, and your income's about the same. Oof. Okay, low growth is going to always lead to a lower multiple on your, PE, or yeah, lower multiple on your earnings, a lower PE. So I'll probably multiply pre-tax income by 8 in this case, break my rule of thumb, but I mean, that growth is just super, super low. All right, let's see. What else do I want to look at? I'll just look straight at their, I want to look at their interest payments. Okay, so let me see. Their pre-tax income real fast is, this really isn't growing either. This has actually shrunk in the last couple years. Not shrunk, but I mean, this is really just no growth at all in income. Wow. All right, let me look at earnings per share, because they've been buying back shares, so maybe their earnings per share is going to be way up. I mean, yeah, it's growing more than the pre-tax income, but still not great. All right, let me get a valuation for this, or actually, no, I got to give them a color first. I'm giving them red. This growth is just way too low. Now, what you'll see, though, is that the companies like this that have low growth, it doesn't pay for them to use their money and invest in more, businesses, because obviously they're not getting a good growth. They're not getting a good return on assets, a good return on incremental capital. So it's better for them to return value to shareholders. And in my opinion, the best way to return value to shareholders is through stock buybacks. So that might be why they're doing a lot of stock buybacks, because they can't really do anything else with the money, which, I mean, it's okay. It's just, like I said, it's not great. I mean, growth and value are just kind of joined at the hip. So you got to have growth, or you don't have to, but a lot of growth gives you a much higher valuation. All right, so let me take an average. I'm going to ignore this big outlier. I'm just going to take an average of these last 4 quarters, so the trailing 12 months. The average pre-tax income was 74, or I'll just sum them, $300 million for the year, okay? So 300 million, wow, we're going to get another great valuation. Okay, 300 million times 10 is going to be 3 billion, right? I don't need to do that on the calculator. So 3 billion ratioed to get an estimate, divided by 1.1 times 37. It's $101 a share. It's kind of crazy. Yeah, I guess the market just really hates that they're not growing. So you got to ask yourself, is this a company that you're okay holding that's not going to grow? I mean, look, that's for a deeper dive. I just think this is super interesting. This is a case study of, how depressed a stock can get if it's not growing a lot. So just interesting. All right, 2 interesting ones in a row. Let's move to HII. All right, the first thing that jumps out here is look at this equity growth. This is total equity, and this is all your assets minus all your liabilities. And look at this. Wow. All right, big spike there. Let's see what might have caused that. Was it an increase in assets, or was it a reduction in debt? Let's look at debt first. Paid down a little. Well, no, they went into debt, so that's not it. Let's see. They must have had a big uptick in assets. Yeah. Okay, so some kind of acquisition, most likely, unless they just made a ton of money and had a bunch of cash. Yeah, not that. So just an acquisition, but an acquisition that raised their equity instead of lowering it. So I like seeing that. Maybe it wasn't an acquisition. Like I said, this is me looking at these things blind for the first time. These are quarterly reports going back to 2011. All right, let's look at inventory. Remember, this is the ship service company, or they're like the Lockheed Martin for naval stuff. I guess that's how I think of them. All right, let's see. Where is it? Where is inventory? Okay, inventory. Inventory's going down. That's good. That means that, they're making stuff and it's not sitting on the floor. It's being shipped out. So like seeing that, they're carrying a small amount of inventory. Let's see. Their equity was growing. Let's see their number of shares. It's going to be the last thing I look at. Or ordinary number of shares issued. Shrinking. And, that's good. This is a pretty solid balance sheet. Let me just see what the equity was in relation to its debt and in relation to the current market cap. So equity is about 2.8 billion now. So the price to book is going to be about 3 or 4. So 7.4 divided by 2.8. Oh no, 3. Yeah, 2.6 for the price to book. All right, and then I want to also get a debt to equity ratio. So I need to look at their total liabilities. What was this number? 2.7. Okay, so debt to equity ratio, their total liabilities is going to be right about the same as the market cap. So total liabilities is going to be over 2.5 as well. I'm just going to do yellow here. Balance sheet's okay. I'd like to see lower debt and higher equity, but That's just me. All right, let's go to the income statement. That's the pre-tax income. I'm jumping the gun there. Let's look at revenue. All right, revenue is growing, and look, it's kind of on this really starting to take off, starting to get on this exponential. It's not linear, so that's a great sign. And it's not a small amount of growth either. I mean, you went from $2 billion a quarter to now you're well over $2.5 billion a quarter, so pretty strong. Let's see their operating margin, what kind of margins they're getting. Oof, this is low, especially recently, really low margins. Wow, less than 5% margin. Holy cow. Look, I've got to be honest, I'm not super familiar with government contract-based labor, like, not labor, but, these companies that get most of their revenue from the government. I don't really know how to value those, to be honest. It's kind of tricky. But I know I don't like low margin, but that might be the name of the game in the government contract world, right? Because you can't charge too much. I don't know. Let's see pre-tax income again. I know I started there, but I want to end there too. All right, growing and then dropping off recently. I mean, it's obviously going to drop off whenever your margin under 4%, 4%. So that's not good. Look, income, they're not going to get a red because they're not losing money. I'm saving red on the income statement for people who are either not growing at all, like Big Lots, or losing money. So I'm going to give them a yellow, but I'm still not super happy with the income statement. All right, and then let's see, estimated value. What is this number? Let's just say $150 million a quarter. So 150 times 4, 600 million per year. Okay, so times 10 divided by 1,000, 6 divided by 7.4, and I multiply that by the share price, 186, and I get a target price of $151 a share. All right, straight yellow across the board. That's pretty mediocre. I know that this one's a lot of people have been talking about this one though, so it might still be worth a deeper dive in case I'm missing something. Like I said, this is a very high level valuation. And real quick, as far as the value goes, it'll light up green if it's more than 20% higher than the share price, and it'll light up red if it's less than 20% or less than 80% of the share price. Anywhere in between 80 to 20% of the share price is going to light up yellow, so just keep that in mind. All right, let's go to HP. This is another one I've heard a lot about, and I've never really done a full valuation on him. I've never really looked at him other than I think I saw a couple of YouTube videos on him, but I wasn't really paying attention. All right, so hope you're paying attention to this one, right? If you are, like, subscribe, okay? Let's see. Their assets dropped big in 2015. I don't know what that was. Let's look at this recent trend, okay? Rising. Look, total assets really doesn't tell me much. I want to look at equity, their assets minus their liabilities. I want to look at the net worth of the company. So total equity, what? Negative, more liabilities than assets. Hold up. That's terrible. Don't like seeing that at all. Total liabilities, $40 billion of total liabilities compared to, how much was the total assets? $40 billion of assets? Yeah. No, thank you. I'm not looking any further into this balance sheet. That is a red. Okay. Yeah, I don't need to look at anything else. Okay. Let's go to income statement. Just so you know, at this point, if I'm looking at a company and I get negative equity, I'm done usually. I know that that's not always the case, that sometimes it's good to invest in companies that have equity that's low or negative because they're making so much money, but I just keep it simple and move on usually. All right, total revenue growing recently. I wonder what happened here. I mean, I'm sure, like I said, y'all probably screaming at me telling me that it's obvious that some event that I don't know about, but recently it is growing. So like seeing that, let's look at their gross margin because they sell computer parts, right? So their gross margin should be, pretty consistent. Yeah, and look at this, rising recently. That's good. And whenever I was talking about gross margin, I meant they sell pieces and parts for computers or whole computers. So gross margin is a great metric to measure because they buy the raw materials and then make the products and sell them. So I like using gross margin usually. It's just hard to use gross margin with like service companies because what is your raw material if you're a service company, right? It kind of gets gray area and it's harder to compare apples to apples. But any type of company that's selling products, gross margin is a great metric, okay? And it's pretty low. I mean, it's growing recently, but it's pretty low. Let's see. What is their pre-tax income? This is just strange. It's like very consistent with upticks and then, I'm just not a fan of this one. This one's kind of too confusing, All right, I'm going to do a yellow, and then let me get a estimate. I'm just going to take the average like the last 12 quarters, so the last 3 years, and I get an average of $1.1 billion times 4. I was backwards. Okay, so $44 billion is my estimate for pre-tax income. Ratio that down to get a target share price, and I get $41 a share. Wow. I've seen this one be like the darling of a lot of people. They say that this is super undervalued. I'm not seeing it at first glance. It doesn't mean that it's not. I'm just not a fan. Okay, what's next? Oh, Keurig Dr. Pepper. Okay, let's go. All right, I know it was tough on Keurig Dr. Pepper as far as the product goes, but that's just my taste, right? I think if it's a good company, it's a good company. So let's see. All right, this must have been the merger between Keurig and Dr. Pepper. I think I'm smart enough to put that together, 2 and 2 together there. All right, let's look at equity. All their assets minus all their liabilities. And then we're also going to look at tangible equity just because I'm sure that acquisition involved a lot of goodwill. So yeah, their equity is good. They have, positive equity that's, close to $25 billion. But let's look at tangible equity because like I said, I imagine they have a lot of goodwill. Okay, so tangible book value, yeah, negative. Oof. All right. Where's their goodwill? How much goodwill do they have? Goodwill and intangible assets. $45 billion of goodwill and intangible assets on a market cap of $55 billion. That's gross. Like Dr. Pepper. I'm just kidding. Let's see their total number of shares. Are they buying back shares? Oh, they diluted a bunch to get that acquisition. Okay, no, this is a red. All right, moving on to the income statement. Total revenue. Okay, hold up. Tide's turning around, right? Look at this revenue growth. That's awesome. Let me see something, though. Well, I'm going to do it from their pre-tax income. Let me look at their pre-tax income. I must not have numbers here. Okay, so the acquisition, I'm going to go back to the balance sheet real fast and look at their total assets. So their total assets went from $10 billion to $50 billion, 10 to 5, so increased 5 times, okay? Are we making 5 times as much money? No, not even close. Okay, you were making like $3 billion and now you're making 6. So yeah, you've had great growth, but your return on assets, your return on equity has just been terrible. So not terrible, it's just I don't like growing a bunch of assets but then getting a worse return on equity. If you increase your assets by 2 times, in my opinion, your income should go up 2 times. I mean, I know I'm being picky, but we got thousands, tens of thousands of companies out there to choose from, I don't need to pick one that's getting a lower return on assets than it used to. But it is growing, right? I said I'm going to reserve my red for companies that are losing money or not growing, so I'm going to give them yellow, but keep in mind, that's a borderline red. As far as an estimate goes, I'm going to take $600 million a quarter as my number. So $600 million a quarter times 4 is $2.4 billion. $2.4 billion a year in income. And then I'm going to multiply that by 10, 24, yeah, row, not good. Okay, divided by 55 times 38, $17 a share. All right, here's the deal. I think that a lot of people are putting a higher multiple on this, and by a lot of people I mean the market, because of the recent growth. But like I said, I'm not impressed by the recent growth because the growth has a lower return on assets. So I know I'm being picky, but being honest too. So, all right, let's go to waste management. Last one. All right, waste management. I think I remember reading something about Bill Gates having this as one of his top holdings, along with like Caterpillar and stuff. So let's see, equity first. Total equity, $7 billion. Yeah, $7 billion on a market cap of 60. Whew. That's a high price to book value, There was a time whenever, like, if you read Ben Graham's books, he talks about buying things for, like, less than working capital, just and stuff like that. And it's so foreign now. It's pretty crazy. And usually if you find a stock like that, it's got a bunch of stuff wrong with it. Let's look at their working capital, just for example. Well, it's negative, for one. All right. Bad example. All right, let's look at, let me see what their tangible book value is. Oh man, I'm so tired of these negative tangible book values. I'm very opposed to goodwill. I know that some people doesn't bother them, but I don't like buying assets and stuff that are not real assets, not tangible assets. I feel like it's much harder to understand. So I'm going to put a red here for negative equity or negative tangible book value and a super high price to book value, even including the goodwill. So let's see what is, okay, yeah, red. All right, let's go to the income statement. All right, revenue's growing. That's good. Let's see what else. All right, let's see their operating margin. Operating margin is pretty steady too, between 15 and 20%. I mean, it's declining a little bit, but that's nothing. It's a consistent company, nothing crazy there, nothing wrong. And then lastly, pre-tax income Yeah, this is growing too. It's not growing that much though. And they got these 2 random, I guess, write-offs or something. So I don't like that either. Okay, that's getting a yellow. And what's my estimate? I'm going to say 600 million again. 600 million a quarter times 4. That's 2.4 billion a year times 10 divided by 1,000. So 24 billion. Oh, this is going to be just like Keurig. All right, divided by 59 times 142. Yeah, we're way overpriced, in my opinion. All right, 58. Man, so we got, what? These 4 right here, I would just stay away from completely. I really didn't like the balance sheet on Big Lots. Academy is the only one I think I might look into further, but even that's, I'm not too big a fan of buying something with a yellow balance sheet, to be honest. The balance sheet to me is like my #1 metric. That's my favorite thing to look at. Seeing a company with a healthy balance sheet, that's like my way that I judge management. Or not judge management, but that's how I intuitively think of business and think of my own personal finances. So I feel aligned whenever I see companies that put the same kind of principles on their balance sheet. But look, that's just my take on it. Anyway, I hope you learned something. I hope you enjoyed the video. Put more recommendations in the comments below. That's great. I love the recommendations. It gives me ideas for new videos, and we learn a lot along the way. So appreciate it. Thanks again. Bye.